Hi there, Shingirai here again with another update on portfolio performance over the past week. On a one-week basis, all 10 of the CBAM portfolios outperformed their respective benchmarks, with returns ranging from CBAM 1 returning 0.39% up to CBAM 5 returning 2.26% on the one-week basis. We continue to see sustained periods of strong performance from our clean energy positions, and that will be reflected in the performance of iShares Global Clean Energy, up 4.81% on the week, and then some recovery there for our US positions after a cooler inflation reading of 8.5% for the month of July, coming out of the States and giving some optimism there and leading to a US stock rally that would see both positions in Fidelity S&P 500 and JP Morgan US equity income up more than 3.7% on the 1 week. In terms of detractors from performance, again, the harder inflation numbers coming out of the UK would lead to some weakness there for LNG UK gilts, and also some weakness that we can begin to see for sterling corporate bonds, with those positions down more than 0.6% on the week. We do continue to see sustained recovery from Japan, up more than 2.5% on the 1 week basis, and that's on the back of a stronger 2.2% GDP growth in the second quarter, and as well revising upwards Q1 GDP from previously being a contraction to be re-rated as an expansion, and giving some optimism there for consumption as businesses experience lifts from COVID curbs. In terms of quarter-to-date performance, 4 out of 10 of the CBAM portfolios outperformed their respective benchmarks, with returns ranging from 3.29% for CBAM 1v2 up to 8.19% for CBAM portfolio number 5 in what has been a relatively risk-on quarter. As mentioned earlier, we continue to see protracted strength from our clean energy positions as the market mouths a European energy crisis, and really beginning to think again at alternative energy sources outside of fossil fuels. And that would see both the PICTET and the iShares Global Clean Energy positions up more than 23% on the quarter-to-date basis. We have seen some recovery as well from our European equity positions alongside Japanese equity positions, and India also seeing that recovery there from Bailey Gifford, up 17.47% on the quarter, and our European, Japanese and Indian positions up more than 10% on a quarter-to-date basis. Again, as we've highlighted in the past 2 weeks, we see some weakness there for Columbia Threadneedle China, HSBC China and Bailey Gifford China, all down more than 9% on a quarter-to-date basis on the back of some weakness there that we've been seeing in the Chinese property market, some geopolitical tensions between China and Taiwan, and also some protracted risks that we've been seeing there in terms of inflation coming up at 2.7% reading after the prices of hogs soared more than 20%. And that was largely a food-driven inflation reading coming out of China, leading to some cautiousness rather around Chinese equity markets. But then again, on the longer term, looking at the goals being set by the Chinese Communist Party, which is set to have a conference in November, where we widely expect Xi Jinping to retain control of government. But we still do continue to see that as an event or an opportunity rather, where China could potentially begin to review their zero-tolerance COVID policy, which has obviously been a detractor from GDP growth and economic growth in China. And there, that might be an opportunity for the Chinese Communist Party to declare victory over COVID, and to say that their zero-tolerance COVID policy was actually effective, and thereby allowing them to lift some of the restrictions that have been a headwind both economically and for the financial markets in China. In the longer term, we still continue to see GDP growth per capita going above $10,000 as of 2020, and that is widely to go up by 50% over the next 10 years. Should be relatively positive for the Chinese economy and Chinese markets.